All right, we started the day with a big jobs report, but the markets closed about even as investors try to digest a big week of news, the Fed's move and the elections. Joining us now are Chris Rupkey, Chief Financial Economist at Bank of Tokyo-Mitsubishi, and Neil Grossman, Chief Investment Officer and Managing Director at TKNG Capital Partners. Guys, thanks for coming in. Kind of last minute because, Chris, I got your note this morning, and it struck me. I remember you were on Monday, not last week, just this week at the beginning, and said, we don't think that quantitative easing is really necessary here and not really sure it's going to help as far as the jobs picture. And today you said, actually, it looks like it really is helping. And I saw a number of other economists write to me this morning saying pretty much the same thing. Is it already working?
Well, I think I was being a little sarcastic there. I was saying, they announced
That's why email is such a bad way to
Yeah, they announced it Wednesday, and all of a sudden we have big jobs on Friday. The revisions in the job number were tremendous. 252,000 more new jobs today than at 8:29 this morning. That's simply incredible. Anyway,
well, if you don't adjust it for seasonality, I think we added almost 1 million jobs in October.
Really? Oh, that's interesting. But
is that right? And by the
919,000 is almost 1 million in my book.
It's the third strongest October report going back over 20 years.
So not bad.
Not bad. The issues will be, one, this is an election year, so you're going to see if any of that was temporary. You also may have some earlier hiring for the Christmas season. And I think one of the real interesting issues that you may see with the statistical numbers right now is that the econometric models that the statistical bureaus use are based on time series of data that are so different from the environment we have that you don't really know overall how good the numbers are. And just to put it into perspective, during the Clinton years, those 8 years, we averaged over 200,000 jobs a month. So we've had 150,000 report. I'm not quite sure it's time to get really, really excited.
It would have been better. It would have been good, though. I think Chris pointed out this morning, if the Democrats had this number come out last Friday.
It could have been a little bit better, but let's face it.
For them, depending which side you're on, right?
Well, when he took office, unemployment 9.7. At 7.9, so it's still tough.
Let me ask you, does this say that QE2 and all the stimulus measures, fiscal and monetary, they're working? Are they working?
The older measures, you can argue, are working. You can also argue that the announcement and the public evolution of the discussion have sort of helped people feel better. But whether it's really necessary in any of the more recent ideas are necessary, or just the old stimulus is sufficient or not, we won't know for a while. I'd also say one interesting point I found, the last 4 months has been not easy to trade and invest because you've had so many competing forces and people. You sort of thought with the election out of the way and the announcement of QE that we might be entering a period where you could feel comfortable about making decisions. I'd say this number actually raises the uncertainty again. You're going to go right back to trying to figure out what the next meeting is going to do and how long it's going to take them, if at all, to change their tune. I would assume that the chairman is not about to let this unwind in the first or second. We haven't even started buying, but by February, you may start to see the data sufficient, and the inflation numbers in particular, which we will see and watch, that the Fed starts to question what it did, and that's not helpful.
Well, and Chris, you said in your note that maybe this will temper the quantitative easing. You weren't being sarcastic there, were you?
No, because...
But Adam has also brought up, maybe the markets are saying, look, if we get jobs numbers like this continually, then you can at least say goodbye to QE3 and QE4, right?
Right.
Yeah, I think it depends on how quickly the unemployment rate comes down. Let's not forget the unemployment rate was stuck at 9.6 today. But generally, if jobs are running in this general area, 159, closer to 200, the unemployment rate should come down. It may be just a month away from coming down anyway.
The only problem you'll have with that, and the Fed would consider this, by the way, to be a good problem, is you could see the unemployment rate drift higher first as people enter the workforce looking for jobs. That would not necessarily be a problem.
Will the markets perceive it at that?
I'm sure if you see that happening, yes. There'll still be some question marks. I also think one of my big questions about employment, if you look at the structural issues right now, we stopped losing jobs actually probably about a year ago. But what's happened, I think, is you're seeing that people are staying in the workforce longer. And the real issue to me is to watch how young people can enter the workforce, because they're really going to be the engine of growth going forward.
And they've had a really tough time.
And they've had a really, really tough time. So I think that's very, very important to watch right now.
By the way, even if the unemployment rate does come down, a little bit, or even by one handle, it's still a lot, right? I think we were talking about with Diane Swank, what's an extended period, and she said, well, by her accounts, it's into 2012. Do you guys see as well the Fed holding
the
off?
Extended period, when it came out, when they first used the language, it was thought to be like 3 or 4 meetings.
And we're talking about what the Fed says, how long it's going to be that they hold interest rates this low.
I think they just see, like 3 or 4 meetings, a reasonable period of time. I mean, when they first used the language, I think Bill Dudley, New York Fed president, said 3 or 4 meetings.
I think one of the problems will be, again, how the markets react. Look, the economic data is still weak. The markets are ahead of themselves. So you're going to have to wait and see if fundamentals catch up with market pricing. If not, I think you have a sequencing issue. And we've seen this over and over again, where the markets run ahead, everyone sort of starts to get confident, and then all of a sudden the floor comes out and it undoes a lot of what you thought the progress being made was.
What about the pressure from overseas? This is something we talked about with Dom and Adam earlier, about other officials outside the United States not very happy about what the Fed's been doing. It's creating chaos, if you will, in their markets, and there could be some countermeasures. Is that going to be a problem to be reckoned with, Chris?
No, I think there's a lot of we had heard earlier that there's a lot of unhedged money flows going into these countries that'll appreciate their currencies and hurt their export trade advantage that they have. But Bernanke came out and said with the school kids this afternoon, he was asked that question by a very intelligent school university student, and he said, what about this? Are officials complaining? And they're certainly complaining. The Brazilian finance minister is complaining. But he said, look, it's in nobody's interest. The U.S. basically has 25% of world output. We have to get our ship in order and get our economy moving forward. That will help world growth, and that'll make these other problems disappear.
But you know what, and Neil, let me ask you to weigh on this. Michael Burry today said, you can't take poison to cure your ills. And yesterday, John Riding from RDQ was on saying, look, the reason we got into this mess was because Alan Greenspan was holding interest rates in artificially low levels.
Well, and David Stockman talked about the heroin eventually killing a patient.
Are we doing the same thing? I mean, are we using the same medicine that got us sick in the first place?
Carolyn Bound says
I think the answer is probably yes, but the circumstances where we are relative to when the Fed in 03 or 04 started to raise rates is different. Look, we have had an enormous unwinding of our economy, and the distortions are enormous. And my concern is, of course, we don't let the distortions unwind. But in the case of what's going on overseas, I think the problems are more than people realize. First of all, Europe's by and of itself a big problem, and you can see that already the peripheral bond spreads are widening measurably.
Right.
Greece is already out again over 10 or 11, over 11%. Portugal's hitting all-time wides.
Okay.
Spain's an issue. Italy's an issue.
No, you're right. Mark Grant keeps running
on and on and on, but
Neil
thanks so much for
Grossman,
coming.
Chris Rupkey.